Hello, everyone. I hope you're doing well. And today I'm here to present a little walkthrough how to go about investing in an NFO and my understanding so far about the concept and my own personal opinion that I so far have for new fund offers, and also the most important aspect, the pros and cons of investing in an NFO. So let's get started with it and understand from what is an NFO to the pros and cons of it and how to go about investing in an NFO. So the very first point is that we need to understand what exactly is an NFO. So an NFO is essentially a new mutual fund offer which is provided to the public in the market before a fund house goes to buy these securities from the market. So there is a subscription time period for which the company opens the window and allows the investors to put in their amount of money that they would like to invest in the market in with the mutual fund. Essentially that would go into the market. And also for easier understanding, it's an the NFO is like it's an equivalent of the IPO that we have for shares, but it's not the same. So you would really say, okay, so Sahiba, what do you mean when you're saying it's equivalent but it's not the same? So for example, in a shares IPO, you get the option to subscribe to it, and similarly in new fund offer you get the option to subscribe to it. But the basic underlying difference here is, in an IPO there is one underlying asset, whereas in a fund there are multiple underlying assets. Generally that's how mutual funds are, you could say, constructed or curated. And uh, and also the other important aspect is that the value of the unit of a fund changes with respect to the underlying value of the assets that are actually the equity holdings under it. Whereas the equity itself does stand a very strong chance of appreciation or listing gains that we easily call them. Whereas for a fund to have those listing gains is not there, because it does not actually list. It's just a pool of equities that the fund house has. So hence it's an equivalent for the funds, but it's not the same concept because they're governed by different functioning. The value of each unit is governed by the value of the multiple underlying shares in that fund, shares or whatever underlying asset class that we have in that fund. So key points which what I understand are very important to note while we are investing, um, is that the minimum subscription amount. So yes, that's a catch here. While a new fund or a fund is available to buy and sell even in a unit or fraction of units basis on the amount that we invest, whereas in a new fund offer, generally companies in India do keep a minimum subscription amount, and also the time period is limited for the number of days in which you could put your money in with the, or you park your money with the fund house. Also the face value of the of each unit of the fund generally comes out to be at 10. So when you're investing for the first time, so you can get a good, you could say, number of units. And also one very important point to note that is, we might have multiple funds on offer, and now that the market space is evolving very high, and also that we are in a bullish market as of April 2021. So there are a lot of IPOs coming in the market. So I'll come to it why there are more IPOs, or NFOs coming in the market while it's a bullish market. So it's very important that we do map the objectives of our investing with the objectives of the new fund that is on offer. So a product might be very good, but it might not be good for the goals that we have at hand. So it's very important to keep our financial goals in mind, and along with that fit in the respective funds or equities or any sort of financial instrument for that sake. So now moving on to the most important and useful and most interesting aspect that I find is talking about the pros and cons of investing in an NFO. So the most lucrative point that I find is that it's you're investing during the bull phase of the market. So while there's green everywhere, so market is on the uptrend, companies do come out with very good NFO options, and sometimes they're also coming up with some new industries or new combinations that gives the investors a good chance to get good number of units also, and also the kind of fund that they would like to have depending on their objectives and their selection. So second is the very important, yes, that they're available at a cheaper rate, which like I earlier talked about, that they're generally at the face value of INR 10. Generally that's what the time is. So otherwise, a timed fund would be at an NAV of, could be from a good performing NAV, could be in double or even triple digits um, value at that day or time. But a new NFO generally comes at a face value of more economical face value, as I would like to mention about it. Also, uh, another pro is that the investment time horizon. So they're very specific about the time horizon, and also it's very helpful in the close ended funds, that if you're looking at something very, very, you have a very set objective. Let's say you have a near future goal of about 3 or 4 odd years, and there is a new NFO in a debt class which is also having the same objective. So that time horizon might match with yours, so that would also help. And also, for me personally, the biggest pro that I've found so far for investing in an NFO is that it might provide you discounts on the face value. So essentially, you're getting the stocks, because the the stocks or the underlying assets at a discount. So that is something very nice. And one example that I found in the Indian market was CPSE mutual fund offer, and it has continued to have multiples. It has had multiple NFOs, and within every NFO they have had a discount. Maybe yes, that the percentage or the proportion of the discounts have gone down, but yes, they still provide the same assets. Or the underlying assets at a discounted rate, because you're providing them the money before it opens up for buying and selling in the retail market. So that's a very interesting pros of investing in an NFO. Cons, um, what I understand is that it's very important to know where you're putting your money, how is it going to be dealt with. So the very first thing which comes right to me is that there's no track record, there is no rating, there's no ranking, and no comparison, and also no understanding of how the portfolio would be and how the past performance has been. So I think it's a very big question mark that where the investments are going, how they're going to be channelized. So I think that is a big downside of investing in an NFO, and we really need to be through and through with who the fund managers are going to be, how has been their track record. So these are all just proxies that we can take, and we cannot be certain still after that how this specific fund is going to work. Second is the most important, is that the performance objective is not cannot be as certain, because it might be it might change from time to time. I mean, I'm not saying that it will change drastically, but at first they might start from a point and then it might change a bit. So that remains. So it's somehow connected to the first point, because it's not an established fund. So it's just getting its foot on the, it's just getting its foot. So that's why it would take some time. So yes, the very important thing that we can understand is that there are no significant cost savings either. So like we had talked about, that they're available at a cheaper rate, but as per my understanding, it's actually not really, does not really matter what rate are we getting it at. And so there are multiple factors to it. Two of them that I would like to mention here is, first, um, the funds, the unit that you're getting. So let's say maybe you're having stock A, that is part of an earlier fund which has an NAV of, let's say, 42 INR, but today you're getting a new fund offer which has the same underlying asset, but you're getting that unit at a face value of INR 10. So essentially the underlying holding of the stock A that we are talking would be lesser in the new fund offer. So actually, there's no cost savings on that aspect. But the second more important point that I find here is that the the kind of charges that a mutual fund can charge for assets under management are higher when they are a smaller fund. So that is also stipulated by regulatory authorities in India. So if you have a smaller size fund, it can actually charge higher expenses because they don't have economies of scale. And as they increase in the size in their assets under management, the cost of managing the fund expense ratios would actually go down. So that's, I think, is a very big con, because essentially that cuts down our returns, right? So that's a point that I think is worth mentioning. Then coming on to the next point is that we have increased risk and uncertainty because there's no track record. And for maybe the same fund, by a fund, similar fund with similar objectives might give us, let's say, returns of X%. But with this fund we might always have that X minus delta, because of it does not have any it does not have any record of consistency, or the ability to generate funds while in downside, or the downside protections. So that's very important thing to note again. So at a point of time you might think that a lot of them are interlinked, but there are slight differences between these points as well. So that's what I'm trying my best to explain. And also the other con is that they're not like IPOs. Their NAVs are not affected by the demand and supply of the NFO units. So it doesn't matter how much you or I would buy, or we as collective people might buy. It just simply depends on the value of the buying and selling of the underlying asset class. So in case of an equity fund, it would only depend on how much, let's say, stock ABC are being bought and sold, not by how much units of our fund are getting bought and sold. So that's one very important thing to understand. And yes, the higher cost comes from the very simple fact that you're not really able to save on the getting, if you're getting it at a cheaper face value, and you're getting to pay higher expense ratio or higher charges for the new fund. So essentially it's not really a cheaper commodity or a cheaper financial instrument to get. So essentially the costs are higher. So all in all, that has been my time for this presentation. Thank you very much, and I would really like to know your questions or thoughts, or anything that I might have missed, or anything that you would like to add to this. Definitely mention that below in the comments. Also, to tell my personal standpoint and my understanding of this, I think definitely NFOs are good options, and I would also like to go into the NFOs which might meet my goals in sort of, you could say, close-ended funds, or funds that I'm getting a good discount at and they fit into my objectives. Whereas I strongly do not believe in going for any new NFO, because I would definitely like to know the track record, or I would rather go for a fund. It doesn't matter what face value of the one unit of that NFO is on that date. If an older of an older fund would give me. So it doesn't matter if an older fund gives me 10% returns and the new fund offer gives me a returns of 7% for a hypothetical situation. So it essentially depends on how it fits into your goals. That is my understanding, and I would definitely do my own due diligence and the parameters. If it matches my parameters, then I would go for it. And that's my understanding of it. Thank you very much for listening to me, and hope you like it. Thank you very much.